Jan, thanks for joining me. Tell us, can the world economy look forward to a better year in 2011?
I think the world economy as a whole can expect another year of strong growth in 2011. I think the US economy within that can look to a better year. I do think that we'll see an acceleration in US GDP growth. There will be, I think, probably some deceleration in growth in other parts of the world where you're already much closer to full utilization of capacity and therefore more concerned about inflation.
Let's talk about inflation for a minute. At least in the US, your argument is focused on the tremendous amount of excess capacity in the economy and how that will keep inflation low for some time ahead. Can you discuss that?
So first of all, in terms of the excess supply and the excess capacity and what that's going to do to inflation, there's a big difference between the advanced economies, the United States, Europe, Japan in particular, and the emerging world. In the advanced economies, and the US is probably the best example, we've got a huge amount of excess capacity. We've got a huge amount of excess capacity in the labor market. We've got a large amount of excess capacity in the industrial sector, in the real estate sector. And to us, it's pretty difficult to believe that in an environment like that, you're going to have an inflation problem. In fact, we think the risk is on the side of having inflation too low relative to central banks' targets rather than too high. Now, in the emerging world, we're in a very different situation. The output gaps, the excess capacity was never as big to begin with in a lot of these places as it was, for example, in the United States. And those countries have grown very, very strongly since early mid-2009. So whatever excess capacity there was has now been whittled down or unwound. And indeed, we are seeing more concerns about inflation in places like China or Brazil or some of the other larger emerging markets.
Risks to the forecast. I'm sure there are many. Tell us, what about Europe? What about trade and protectionism? And there are others as well.
I think there are a number of risks to the forecast. The risk that's probably most prominent in most people's minds at the moment is the continuing crisis in Europe. We think that those concerns are not going to go away quickly. The adjustment within the Eurozone between countries that had a big asset bubble and are now seeing very weak economies, such as in Ireland is probably the best example and the most extreme example. And on the other hand, countries such as Germany that didn't have an asset bubble and that are now actually seeing very strong growth, that adjustment is still going to take a long time. We do think that the policymakers are very committed. We do think that they will do what it takes to stabilize the financial situation, but the economic adjustment is still going to take a long time still. Other risks, I would say in the United States, the biggest near-term risk is probably the fact that house prices appear to be slipping again. We do think house prices will fall by about 5% over the next year. That in itself is not necessarily such a horrible thing. It's not by itself, it would not, we think, trigger a recession or even keep the US economy from accelerating through 2011. But if it's substantially more than that, if we're seeing a 10% drop or a 15% drop, in that case, we'd get more concerned. And that's definitely something that we would put on the list of concerns. And then maybe as a third concern, just the broad view that the imbalances in the global economy, the current account imbalances, while no longer as large as they were in 2007, are still quite large. The United States still has a 3 or 3.5% of GDP current account deficit. If US demand growth picks up through 2011 and 2012, you may see a renewed widening of that current account deficit. That does mean that exchange rates need to adjust, and it may also fuel more calls for protectionism, which we think would be a very unfortunate outcome.
The U.S., you've become more optimistic on the outlook after several years of being really quite pessimistic. Can you tell us how that plays out, and are these changes that we're going to see on Main Street?
We think, yes, they will show up on Main Street, but it will also take quite a long time. We have been quite concerned about the U.S. Really for the past 5 years. We were quite concerned back in 2005 and 2006 about the overvaluation of house prices and the increase in private sector spending and private sector debt creation that went along with that.
Bubble, basically.
Basically the bubble in the housing market in particular. And that has played out over the last few years. We've seen at first a gradual downturn in the economy and then a much more severe downturn in late 2008 and early 2009. Now we think that things are gradually improving. We'll be moving from currently somewhat below trend growth, we think, to above trend growth by the end of 2011.
Meaning?
And we expect, so right now we're probably growing about 2.5% in sort of late 2010, early 2011. We think that goes to 3.5% to 4% by late 2011 and into 2012. That still doesn't mean that the unemployment rate, which is now at nearly 10%, goes back to a normal level of maybe 5 or 6% overnight. It's going to take several years, we think perhaps 5 years, before we get back to that kind of more normal unemployment rate. But at the margin, things are stabilizing and starting to look a little better.
So 5 years until the labor market returns to what we think is a normal position, is that right?
I think that's unfortunately what we're looking at. And even that requires pretty strong growth in the meantime, because you need to grow at a substantially above trend pace to start really to push the unemployment rate down. We've seen growth, positive growth in the US economy since the middle of 2009, but the unemployment rate basically hasn't budged because it just hasn't been enough growth.
Your inflation forecast, particularly for the US, is really very benign for next year, and the argument seems to turn on a lot of excess capacity. What do you mean by that? What
we mean is that if you look around, there are a lot of workers who are looking for a job who can't find one. There are a lot of idle factories. There are a lot of empty houses that are sitting on the market, empty office buildings. These are all likely to hold down the ability to raise prices. We think wage growth is going to be pretty subdued because of the large amount of unemployment. None of those things would suggest that inflation is going to be a problem really anytime soon. And in the near term, at least, over the next couple of years, the risk is on the side of inflation being too low rather than too high because of that.
And by too low, you mean actually deflation? We
don't expect deflation. We do think that inflation is probably still going to be positive, but we only have it at 0.5% to 1%. The Fed's preferred inflation rate would be 2% or maybe a little less. But I think there is a tail risk of deflation. Not our expectation, but it's possible that we'll actually see a period of declining prices. And that would be a problem because it would make it harder to unwind the excess debt levels that still exist, in particular in the private sector. If you have falling prices, given that debt is in dollar terms and doesn't decline, if prices decline, it gets harder to service that debt in an environment in which prices are declining and therefore the real value is increasing.
What about the housing market? It certainly seems that the worst is behind us, but will we see a pickup or a flattish market over the next year?
So I think the housing market is still a source of risk. The level of excess supply in the housing market is still very high. It is starting to come down, but it's still very high in absolute terms. And from an economics 101 perspective, if you have more supply than demand, then you would still be worried about declines in house prices. And indeed, we are assuming some modest further declines in home prices through 2011.
Along the lines of?
5% or so. You know, nothing like the sort of declines, the 30% decline that we had from 2006 to 2009. And I would say that there's no longer a valuation problem in the U.S. housing market.
Really?
The valuation, which was significantly too high back in 2006, clearly in bubble territory, is now roughly in line with long-term norms. And if you adjust for the low level of interest rates, even somewhat below long-term norms. So what we're seeing now is no longer fundamental valuation adjustment, but really more the residual effects of the excess supply that's still out there in the market.
China has become increasingly important to the world economy and the world growth outlook over the past decade. There are concerns about the sustainability of the very high growth rates we've seen in recent years. What do you think about that? Is this sustainable, or is there a risk that actually policy will tighten too much and choke off growth?
So at the moment, I do think that growth is faster than the policymakers would like to see. They're worried about inflation rather than economic activity that is too weak. So what they're trying to do is to slow down the pace of growth over the next few quarters in order to relieve some of these inflation concerns. We think they will be successful in that. We think there will be somewhat slower growth, closer to 9% than to 10% as we go through 2011. But in subsequent years, we still think it's going to be a strong growth story. And we don't think that the policymakers are going to be so aggressive that growth gets choked off completely and we see an actual downturn in the economy. This is tapping on the brakes more really than a full slam on the brakes.
If you look at the rest of the BRICS countries, so Brazil, Russia, India, China, is the growth outlook strong there as well?
In general, we think the growth outlook is quite strong in all of the BRICS countries. China is the strongest of the four of them, but in general, we do have a fairly upbeat view in all of these places, but also an expectation of policy tightening. So it's not just China that's tightening policy. India's tightening policy as well. Brazil, we think, may need to tighten policy quite aggressively in 2011. Because the capacity constraints in a lot of these places are starting to become quite evident.
We've seen over the past few years a real split between growth being relatively or very strong in developing markets, less so in developed markets. Do you think this is part of a permanent shift, or is it something that will fade over time?
I think it's a little bit of both. So there is a much stronger underlying trend in the emerging world. Partly because labor force growth is stronger, especially urban labor force growth in a lot of these places. Partly because there's a lot of room for technology transfer where you basically transfer best practice from the in various industries from the advanced economies into the emerging world, and that provides a lot of opportunity for catch-up. So that's partly a longer-term trend that's not going to go away. Partly, though, from a cyclical perspective, the advanced economies have also lagged behind the emerging world over the last couple of years.
So how is the outlook for commodity prices then, if you do have strong growth in parts of the world and growth picking up in the advanced economies as well?
I would say commodities are a global market, and so for the most part at least. And so having another 2 years of global growth well above the longer-term trend is likely to put upward pressure on commodity prices. That's what you should expect, and that is indeed what we are seeing in a lot of commodities.
So
and if you look at the views of
oil at $100 a barrel?
Oil at $110 a barrel in 2012, from the perspective of our commodity strategists, they do think that there will be upward pressure on prices, really for very straightforward economic reasons, because demand is growing more quickly than supply.